Okay, folks. So you got the quiz review, right? Don't look so lost. Of course you got it. You got it on Monday. Now, so you got the quiz review session, the past quizzes. There are a lot of past quizzes. Okay? My suggestion is start with the latest ones and work backwards, because otherwise they're actually more relevant. They're closer to what this quiz will be in terms of content, because some of the earlier quizzes I got through growth rates before I got to quiz 1. Yes? No, it's actually through 2019. So maybe I'll check, because it should be the connection. So maybe it's connecting to the wrong file. It is updated through 2019. So I will check, make sure it is through 2019. Oh, yeah, through last spring. So basically it should be. They both should be updated. So maybe the link I'm sending is to an old file, so I'll make sure that the link is okay. Any other questions? So remember, first 30 minutes of class, right? 3:30 to 4. You got the seat assignment already, so go to the right room. If you don't know what letter your last name starts with, then I can't help you. So this shouldn't create any confusion. You're in one room or the other, just go to the right room. It'll give you a chance at least to have more space to work. Any other questions? Okay. And what's the rule if you're going to miss the quiz? What do you need to do? You need to let me know before the quiz. That's the key, before the quiz. 3:27, 3:28. I wouldn't cut it that close, because your self-service might fail and I don't know where you are. So give yourself a little buffer. It has to come in before the quiz. Okay? Because what I do is I collect all those emails I get, and maybe I'll put a suggested subject line, missing quiz 1. That way I know that you're missing it. I'll put it into a folder and say these people are missing it. Okay? So it's open book, open notes. I won't say it's easy. I won't say it's difficult. It is predictable in many ways, because if you've seen 33, there's at some point in time you become predictable because you've seen 50 quizzes that I've written. So you know how I write the quizzes, what language I use, and each quiz you'll notice something a little different from the previous quiz. What's going to be different about this year's quiz? If I told you that, I'd be giving away the game. But maybe there is nothing, so don't look for tricks if there are none. Okay? Second, did you get the valuation of the week for this week? I want you guys to give it a shot, right? Because remember what I said, this class, things will happen as we go through the class where we have no choice but to deal with it in real time. I was actually, my plan was to value Kroger for this week's valuation of the week. You know why Kroger, right? That's Berkshire Hathaway's latest. So I wanted to see what is it that Berkshire Hathaway sees in this old, boring grocery store that made them buy it. But things got in the way. I mean, at this point, talking about Kroger, who really cares when you got a market moving all over the place because of the coronavirus? And I know it's a very simplistic way of thinking about the virus. Is saying, are there layers to it? Yeah, I don't want to go into any of those layers, because I'm going to get lost. So keep it focused on very simple ways of bringing it into play. And give it your best shot. See what you get as you play through these things, because if nothing else, you're getting a sense of the levers you can use to ask pretty much any big question. Okay? So today we're going to talk about growth. So I'm going to hit you with a few very generic startup questions. And these are actually, we think of them as intuitive, but actually it's very difficult intuitively to think about the effects. We use revenue growth rates, right? Earnings growth rates. We use growth rates in valuation all the time. 20, 30, 50. We don't even think about 30% growth rate. Oh, that's easy. So just to get a sense of what applying a 30% growth rate over a long period will do, let's suppose I came to you, this was when Twitter was a much smaller company, 600 million in revenues. It stays small because for some reason it never seems to figure out how to get bigger. Okay? But let's say at 600 million, you had big hopes for Twitter, and you thought they could grow 30% a year for the next 10 years. 30%, 10 years. I just want you to give me a guess of what your revenues will be in year 10. If I took 600 million, grew it at 30% a year for 10 years. Somebody with a calculator can help me. I'm okay. 600 million growing 30% a year. What do you think? Is it going to be 1.5 billion, 3 billion, 6 billion, 8 billion, 12 billion? Where do you think you're going to end up? It's a nice guess because, that's pick the highest number. I don't know, somebody help me out. Somebody calculated 60 times 1.3 raised to the power 10. What do we get? Or 600 times? 780. So about 8 billion. So it's 600 times 1.3 raised to the power 10, about 8 billion. That's a lot of revenues. And then you say, well, the management say they can double the growth rate. Where do you think that you're going to end up? Remember, you got 8 billion with 30%. Instinctively, when I say double the growth rate, what are you thinking? 8 times 2 is 16. I should get about 16. You're going to end up around, immense revenues. What I'm trying to say is when you sit down to value a company, you're going to try 15% growth rate and you might get too low a value. So why don't you just make it 20%? 15 to 20 doesn't sound like much, right? And you don't get a sense of what you're making your company do until you look at your revenues. When I valued Tesla with that do-it-yourself valuation, I gave them 125 billion. Now, one of the people who pushed back was somebody, somebody who's a Tesla fan. He said, but Elon said you could grow 100% a year, and they were able, why don't you put 100% growth rate for the next 5 years? So I said, okay, I'll try it out. If I put 100% growth rate on Tesla's revenues for the next 5 years, you know what the revenues would become in year 10? $3.9 trillion. So I wrote him back and said, I know Elon is a really smart guy, but 3.9 trillion is going to be quite a reach. But again, when we talk about growth rates, we're casual, 10 to 20, 20 to 30. So keep that in mind just in terms of perspective. Increasing your growth rate will have an exponential effect on your dollar revenues. Focus on those dollar revenues. For many of your companies, you're going to be tempted to cheat. Cheat in what sense? You're going to let somebody else tell you what the growth rate is, and you can look up that growth rate. In fact, you go to Yahoo Finance and you go to many services, they will look at your company and they will give you all the financials of the company. And they'll also give you an expected growth rate that analysts are estimating. It's called a consensus growth rate. So kind of a public information for U.S. companies. When you see that growth rate, you're saying, that's a growth rate, I can use it. But what's that growth rate in? Growth rate in revenues, growth rate, which of those items do you think analysts are projecting growth in? Earnings per share, net income, operating income, revenues? What do you think growth rate is in? What do analysts project growth in? I like it if there were revenues because you could actually use it in valuation, right? You know what growth rates analysts project? Earnings per share growth. Why? Because they tend to think in terms of earnings per share and PE ratio. So given their frame of reference, you see why this is going to get you into trouble. You're sitting down to value a company. You're trying to get a growth rate in revenues. You're lost. You say, I've never done valuation before. Let me see what analysts are projecting. Yahoo Finance says 15%. You say, this is good. I've got a growth rate. You slap the 15% on your revenues, I guarantee you will overvalue your company. And here's why. As you move down the income statement, growth rates start to get bigger. A 3% growth in revenues will become a 5% growth in operating income. Why? Because you have fixed costs. 5% growth in operating income will become a 10% growth in net income. Why? You have interest expenses. A 10% growth in net income for most U.S. companies will become a 15% growth in earnings per share. Why? What have most U.S. companies been doing for the last 20 years? They've been buying back stock. When you buy back stock, what happens? The number of shares decreases. When you look at earnings, when you look at a growth rate, look for what the growth rate is in before you slap it on something that might be an operating number. And finally, if any of you have interned in an appraisal firm, a valuation firm, remember that 90% of valuations of companies are of private businesses, right, where you value a company for some reason for that owner. And in many of these companies, if you ask the appraiser, where do you get the cash flows, the revenues, the income for the company, they say, I get it from the management or the owners. And their defense is, they know a lot more about the company than I do. Therefore, I'm dependent on them. Let's start with what part of that statement is true. They do know more than you do because they've run the company, they've been in this business. But what's the problem when you get your cash flow forecast from management? First, it's not your story. Second, do you think it might be a little biased? It is going to be whatever they want the end game to be. If you're getting your cash flow forecast from management, you've lost control of this valuation. Doesn't mean you can't listen to them. Doesn't mean you can't look. So one of the things we're going to talk about as we go through growth is how can you look at management forecasts and even ask the right questions as to whether these numbers internally make sense. So let's go back where we left off. We were talking about free cash flows to equity. So let's talk about free cash flow to equity. As I said, if you're lazy and I ask you what's a cash flow to equity, you're going to say just dividends. Right? It's already there. Why am I going to estimating cash flow to equity? But the reason we're going to estimate free cash flow to equity or potential dividends is we know companies don't pay out what they can in dividends. In my corporate finance class, we spend about 4 sessions on dividend policy. We talk about how companies pay dividends. And we know companies routinely hold back cash. Why? Because managers are conservative. They're worried that things can go down, so they hold back cash. Why? Because they want to control the cash and run empires. But for whatever reason, if all you do is focus on dividends, you might be missing big chunks of value in this company. So I'd like to estimate how much a company pays in potential dividends. And here's what you cannot do. You cannot assume earnings are dividends. I've seen analysts take the earnings of a company and say they're potential dividends. Well, technically that's true, right? Technically, you could pay your entire earnings out as dividends, but if you do, what kind of growth rate will you have as a company? If every year you take all your earnings paid out, you're going to have a 0 growth rate. The minute you assume a growth rate, you can't discount earnings. So any discounted cash flow model where earnings get discounted don't make sense because you're having your cake and eat it too. Okay? So when you think about estimating cash flows, you want to estimate cash flows that could have been paid out given the growth rate you're assuming. And that's what I'm going to try to do with potential dividends. Okay? So here's my very simple measure of potential dividends. I start with net income. Why? Because I'm looking at equity cash flows. I subtract out net capex and change in working capital. Why? Because that's cash leaving the company. You're reinvesting back. And if you have debt payments to make, remember, the way I think about this is you're the owner of a business and you're writing out checks to different people. There's a capex check, the working capital check, there's a check to the bank for paying off debt. What you're left with in the till after you've met every conceivable need is yours to take out of the company. That's your potential dividend if this were a private business. That's what I call free cash flow to equity. It sounds fancy, it sounds like I'm doing some magical thing, but essentially I'm estimating how much cash is left over after I've met every conceivable need. Where would I find? So if you look at those line items that I need to get free cash flow to equity, which financial statement should you be spending your time on if you're trying to estimate free cash flow to equity? The net income obviously you can get from the income statement, right? But every other item there is going to be in your statement of cash flows. Capex will be in the investing cash flows. Depreciation and change in working capital will be in the operating cash flows. And debt repayments and debt taken on will be in the financing cash flows. You stay in the cash flow statement, you should be able to compute free cash flow to equity. Let me ask you a question. Could you have a company with positive net income and negative free cash flow to equity? Obviously, right? Yes. So what has to be true for a company to have positive net income and negative free cash flow to equity? Because remember, look at those 3 intermediate line items. What can cause positive net income to become negative free cash flow to equity? Large capex relative to depreciation. Always add that because most companies with large capex tend to also have large depreciation. If they're both large, they offset each other. But if you have large capex relative to depreciation, usually the case if you have a growing company, you could have negative cash flows. That's one. What else? If you're a company with tremendous working capital needs, remember every time you sell stuff, you're allowed to record it as revenues, right? But let's say you never collect the money that's due to you. You could be showing great net income, but your cash flows are going to be through the drain because your working capital is building up. So it could be because your working capital is out of control. There's a third scenario we can end up with negative. Look at the last line item. What does it say? Debt repaid is a negative cash flow. Debt you take on is a positive cash flow. If you're a company with a lot of debt, a hangover from the past that you're paying off, you could have huge debt payments, in which case you could be making money and have negative cash flows. So the reason we compute free cash flow to equity is to get a sense of what that number looks like. In fact, there's a shortcut that I can use when I'm projecting this number into the future, And here's what the shortcut looks like. It starts with net income. I project out net income. Then I look at the net capex, the capex minus depreciation, and I look at how much of that comes from me as an equity investor. When I do equity cash flows, all I care about is me. I don't care about what the bank has to do. So if 80% of my net capex has to come from equity, I subtract that out. And if 80% of my working capital needs come from equity, I subtract it out. I end up with free cash flow to equity. It's a shortcut you can use when you're making projections on free cash flow to equity. And here are the 4 items you need to project: net income, capex, net capex, change in working capital, and your debt ratio. And if you can do that, you can come up with the free cash flow to equity. So let me give you an example. Okay? If you, incidentally, if you use a statement of cash flows, these numbers are pretty much there. You can compute the free cash flow to equity. Let's take a look at what this looks like around the world, and I'll give you an example. So at the start of 2020, I went around the world and I collected the free cash flow to equity cumulatively at all companies. So this was for 43,000 publicly traded companies, the dividends and buybacks, and the collective cash flow return. The free cash flow to equity globally was about $605 million. The cash return collectively was about $2.67 billion. We've got an imbalance across the world in how much cash is being returned relative to the free cash flow to equity. And I've also listed out the percent of companies paying dividends by each. By itself, this table just gives you an overview. What does the world look like in terms of dividends and buybacks? And the interesting thing is, you look at buybacks, the conventional wisdom is U.S. companies buy back stock, but the rest of the world doesn't. That is starting to change, because you can see buybacks starting to show up in the rest of the world as well. Buybacks are not going away. This is a different way of returning cash. And when you think about your free cash flow to equity for a firm, a company might not pay out its that free cash flow to equity as dividends, but if the cash builds up, eventually they will use it to buy back stock. So the example I'm going to use is Disney way back in time, I think 1997. It's actually the company I use in my corporate finance class to illustrate corporate finance. It's one of the 6 companies I use. So everybody's familiar with Disney, right? In fact, if you're reading the news on Disney, something very big happened at Disney yesterday. Do you know what it was? Bob Iger stepped down unexpectedly. As I said, in my corporate finance class, this is my lab experiment. And here it is, ruined right in the middle because the CEO walks away. But it's going to make it interesting. So in 1997, I computed the free cash flow to equity for Disney. I started with a net income, $1,533 million. Their net capex was about $612 million, capex minus depreciation. But about 24% of that came from debt, 76% came from equity. So play the game of an equity investor. Your net income is $1,533 million. About 76% of the $612 million comes from equity. And about 76% of the working capital change comes from equity. The free cash flow to equity was about $704 million. What does that tell me? In 1997, if Disney had paid out exactly what they could afford to pay out, their dividend should have been they actually paid out $345 million. That's what I mean about companies holding back. When you compute the free cash flow to equity, often the number will be higher than the dividend. Okay? That free cash flow to equity, though, is a function of how much they generate as income and how much they reinvest, and also a function of how much they borrow, right? Because as you borrow money, think of what's happening here. Less and less money has to come from equity. So I did a very simple exercise. I said, what would happen to my free cash flow to equity, that's $704 million, if I borrowed more money rather than less money? And something very interesting starts to happen. Same net income, same net capex, same change in working capital. The more of my reinvestment I borrow, the higher my free cash flow to equity. The intuition is, if I borrow the money, I don't have to come up with the money. And so as I borrow more, my free cash flow to equity goes up. What's the value of equity? It's a present value of free cash flow to equity, right? And this seems like a great way to increase the value of equity in a company. Keep pumping up debt, and as you pump up debt, your free cash flow to equity goes up. What am I missing here? It can't be that easy. Well, let's assume this is on the marginal projects. So the net income, it reflects the existing projects, and the new projects, I'm borrowing a lot more money. So the existing projects, I keep the debt ratio where it is. So that's a good point, though. If I did this with my existing, so on the new projects, I'm doing this. So what am I missing when I do this? You become more risky. What do I discount free cash flow to equity back at? My cost of equity. What drives the cost of equity? Risk-free rate, risk premium, and beta. What beta do I use? A levered beta. As I borrow money, guess what? Here's the other shoe waiting to drop. I have higher free cash flows to equity, but I also have a much higher beta and a much higher cost of equity. Is there an optimal choice? Yes. In fact, one way in corporate finance, we come up with the right mix of debt and equities by looking for that mix. There's no freebie here. But I'm amazed at how many people I talk to say, hey, let's borrow more money. It'll make my return on equity higher. It'll make my cash flows. You're right, it will, but it'll also make your equity riskier, and I'm not sure your value is going up when you do it. Your cash flows and your return on equity might be going up. So any questions on free cash or equity? So now let's close off, and this is going to be the final piece of this cash flow puzzle. As I said, when you do capital structure in corporate finance, you're looking for the right mix of debt and equity for your company. Okay? So as I said, as you increase debt, your free cash flows to equity go up and your cost of equity go up. So I'm going to read a series of statements to you. I've kind of given away the answer, but let's see whether you can negotiate your way to an answer. So the first is increasing leverage will increase value because the cash flow effects will dominate the discount rate effects. In other words, cash flows are higher, discount rates are higher. But if that were true, what should every company be at in terms of debt ratios? They should be at 99.99% debt, right? The second statement is increasing leverage will always decrease value because the cash flow effects will always be dominated by in which case, every company should have no debt. The third is very interesting. Increasing leverage will not affect value because the cash flow effects will be exactly offset, it's almost magical, by the discount rate effects. This is corporate finance's most famous theorem. You know what it's called? The Miller-Modigliani theorem. In the Miller-Modigliani world, debt has no effect on value because the benefits of debt are exactly offset by the costs. I don't want to dig too deeply. There are some assumptions they make about taxes and default that lets them there, but that's a Miller-Modigliani theorem. I don't believe in A because if that were the case, everybody would borrow everything. I don't believe in B because then nobody would borrow any money. I don't believe in C because then I wouldn't be teaching a capital structure session in my corporate finance class, which means by elimination, I must believe in D. Any of the above are following depending on who you are as a company. For some of your companies, increasing debt will increase value. Why? Because you're under-levered, you have too little debt. For some of your companies, increasing debt will reduce value. And for some of your companies, you might be close enough to an optimal that increasing debt will have no effect on value. I can't tell you one thing will hold for every company because it will not. Okay? So it's kind of a compressed version of capital structure seen through the eyes of valuation. Which brings me to the next piece. So we've talked about discount rates, we've talked about cash flows. Now let's leave our safe spaces and talk about growth. When valuing a company, people always think of growth as a good thing. You know, if you increase the growth, the value should go up. That's not necessarily true. Growth has a good side and a dark side. The good side of growth is when I use higher growth, my revenues get higher, my margins get higher, my profits get higher. The bad side of growth is to get that growth rate, I need to reinvest money. It drains my cash flows. The effect of growth is which side dominates. Okay? Which side do you think wins in most companies? The good side or the bad side? You'd like to think it's a good side because you spent all of business school talking about why companies should grow faster, right? Later in this class, I'm going to show you that across companies globally, the dark side wins out over the good side in about 2/3 of all companies. Growth is not always a good thing. It's actually a bad thing at many companies because you're growing, but you're not creating value as you grow. So let's talk about ways of estimating growth because this is a challenge you're each going to face with each of your companies. Fundamentally, there are 3 ways you can estimate growth. The first is you can look at the past. You can look at historical growth. And we'll talk about the pluses and minuses of that, and we'll start with that. Second, you can outsource growth. You can let somebody else tell you what the growth is, analysts, managers, because it allows you to say if something goes wrong, it's their fault. And the third is you can estimate growth and tie it to what the company does, how much it's reinvesting and how well it's reinvesting. My bias is to push you towards the third approach, but I'm going to give you the first 2 so you can see the choices because many people value companies using one of the first 2 approaches. Let's start with historical growth. Historical growth, you're just looking backwards, right? So if I ask you what's your growth rate for your company, you can give me a growth rate. You can call it a historical growth rate, but 3 people looking at the same company will give me 3 different growth rates. You're saying how come? One, it depends on how you compute the growth rate. Now very quickly we'll take you through the math. You can compute the growth rate by computing the growth rate each year for 5 years, adding them up and dividing by 5. That's an arithmetic average. Or you can look at the compounded growth rate. It will depend on what time period you use for your growth rate, what your starting point is and what your ending point is. It will depend on what metric you compute the growth in, revenue growth, earnings, operating income, EBITDA. My point is there is no historical growth rate that is going to be a number we all agree on because it depends on how we compute that number. So I'm going to start with some very simple mechanics of computing growth rate, including what do you do about computing a growth rate when you have a company that goes from losing money to making money. You're saying, what's the big deal? You're going to see that computing a growth rate becomes almost impossible to do when you go from minus to plus. So let's start with Motorola. This is actually a valuation I did late 90s as part of one of my books on the first edition of the dark side of valuation. Motorola at that time was an older tech company competing against all these younger tech companies. So what I did was I wanted to compute a growth rate in Motorola's past numbers, and I looked at 3 metrics: revenues, EBITDA, and EBIT. In fact, I had net income and earnings per share as well, but I didn't even fit them in. So basically 5 different metrics. You're saying, so what? Let's take revenues. I computed the growth rate each year, and I computed an arithmetic average, a simple average of those 5 growth rates, and I did that for each of the numbers. And you can see my revenues grew at 7%, my EBITDA grew at 11%, my EBITDA grew at 11%, my EBIT grew at 43%. Why? Because as you move down the income statement, your growth rates start to get bigger. I also computed a geometric average. What's a geometric average? Or how do I compute a geometric average? I don't even need the middle numbers. I take the ending number, I take the starting number, I divide the ending number by the starting number, and I look at what the compounded growth rate was over the 5 years. And that compounded growth rate with revenues was about 6.8%. Very close to my arithmetic average. You're saying that's a lot of work for very little. But if you look at EBITDA, the difference is much larger, and for EBIT, it's even larger. So let me ask you a question. When you compute an arithmetic average of a series and a geometric average of a series, what is it that causes those 2 numbers to diverge? Or put differently, when will you get exactly the same answer using both those averages? If you have 99999 for 5 years, your arithmetic average is going to be 9, your geometric average is going to be 9. Or put differently, the greater the standard deviation in numbers, the more volatile your numbers, the bigger the divergence between arithmetic and geometric averages, and geometric averages will always be lower. Now do you see why this makes a difference? Let's say you sit down, you go into a company, you want to value the company. You ask the company, how quickly are you growing? And they want to put the best possible spin on what they've been doing. Which growth rate are they going to give you, arithmetic or geometric average? They're almost always going to give you an arithmetic average growth rate. They're not lying. They're going to give you an arithmetic average growth rate. If you take that number as a given, you're setting yourself up to overvalue the company. So I know this sounds like inside statistics. Who cares, arithmetic or geometric averages? But those numbers can be very different, especially for very volatile companies where the numbers jump around. Now let's talk about money-losing companies. Let's assume you're looking at Time Warner in 1997. In 1996, Time Warner had an earnings per share of minus 5 cents. In 1997, its earnings per share is expected to be plus 25 cents. So let me start with an easy question. You go from minus 5 cents to plus 25 cents. Is this a good year or a bad year? Sounds like a good year, right? So I ask you to compute the growth rate. How do we compute growth usually? We take the 2 numbers, we take the difference, and then we divide by the earnings per share last year. If I do that for Time Warner, you know what my growth rate is going to be? It's going to be minus 600%, which makes absolutely no sense. You have a really good year, and I'm telling you growth rate is minus, but mathematically I did exactly what I was supposed to do. So let's talk about the alternatives. You're saying, how do you get the minus into a plus? The minus bothered me so much. I said, okay, let me just draw a line through the minus. It's a plus. Makes more sense. People actually do it. They call it the absolute growth rate. That way they get away with it. So basically this way minus becomes plus. Nice way of getting around it. Means absolutely nothing. There's some people who claim it's plus 120%. You see what they did? What's causing the minus here? It's not what's in the numerator, it's what's in the denominator, right? So there's what they do. They take the negative number that they had, the last year's number, just replaced it with this year's earnings per share. Again, you're not supposed to do it, but at least now you're getting a positive number. The bottom line is when you go from negative to positive, there is no good growth rate you can compute for a company. You know the most honest answer is NMF, not meaningful when you go from negative to positive. So when you have companies, and some of your companies will be true, you're going from negative to positive, you're computing growth rates, don't be surprised to get strange looking numbers, because what you're getting is the math working against you. And don't try to fix it. There's really nothing you can do that will give you a meaningful growth rate for the future. Might as well just ignore the growth rate for that year and work with what you have. Final point about growth. I don't know whether any of you have heard of Callaway Golf. They make golf clubs. They make the Big Bertha, this golf club. And when they first came out of the Big Bertha, it was a huge, revolutionary product. And so it was a small growth company. In fact, it was 1990, their net income was 1.8 million. And as they succeeded and more people bought Big Berthas, their net income went to 122 million. Their growth rate over those 5 years, the compounded, the geometric average growth rate was 102%. So let's start with a fact. They've had a really good 5-year period. Their growth rate has been 102% a year. I get really excited. I say, okay, I'm going to value Callaway Golf. I'm going to take that past growth rate of 102%. I'm using a geometric average. And I apply it as my growth rate for the next 5 years. Here's what Callaway Golf will look like if I put a 102% growth rate for the next 5 years. 4.1 billion net income. You know what that requires? That everybody in America have a Callaway Golf Club even if they don't play golf. To do what? Weapon? I don't know. So, there might be a story I could tell, but my point is there's no way Callaway Golf can get this big. But for those of you looking at past growth rates and extrapolating, if you have a young company and you're not careful, this is exactly what you'll end up doing to your companies, making them too big to survive as companies. Final point about historical growth. All of this work on coming up with the historical growth rate is to do what? So we can project out into the future, right? Do you think it's that useful to know how quickly a company has grown in the past? We act like it is. Do you think it helps us that much? What do you think? The conventional wisdom is yes, do the historical. Many of you will go to work at investment banks and you'll be given, go compute the historical growth rate, last 5 years, last 10 years, last 20 years, whatever. About 30 years ago, this Britisher comes over to do a PhD in economics here. His name was IMD Little. That was his actual name, Little. And he picked a topic to do research on. And here's what he did. It was like the early 60s. And he wanted to answer this question. Does knowing the growth rate in the past help you estimate the growth rate in the future? So he did something very interesting. He took the 1950s, which is the time period he had data for. He broke it up into two time periods, 51 through 55 and 56 through 60. He computed the growth rate in companies between 51 and 55 and the growth rate for those same companies between 56 and 60. What's he trying to answer? If I know the growth rate in the first period, so he computed a correlation between the two growth rates. Now if past growth is good at predicting future growth, what should that correlation look like? Very high and positive, because then if you have high growth in period 1, you get it. If past growth is predictive of negative growth in the future, you should get negative correlation. In fact, what's the worst possible outcome? I'll give you the title of his dissertation thesis, and you can probably guess what kind of correlation he found. He called it higgledy-piggledy growth. It's like a nursery rhyme. Basically, he said, I don't find any correlation. Cautionary note, the next time you get carried away and say, my company has great growth in the future, all it's telling you is there's been great growth in the future. Extrapolating that number, history suggests, can be very dangerous. So can I compute the historical growth rate for a company? I think I can. Am I going to use it most of the time? Not really. I still do it for every company I value. I look at the past because there is information in it that I can use to tell a better story about the company, especially in changes in the number across time. But I almost never value a company with the past growth rate put in as my growth rate for the future. So that's the first stop. You can look at the historical growth rate, but don't make that your growth rate valuation unless you feel really good about continuing with that growth rate. Let's talk about analyst forecasts of growth. Yes?
What companies do you think you could do that with?
A regulated utility, for instance, you know why? Because Con Ed, when it goes to the pricing commission, because Con Ed's not allowed to set power prices in New York. They have to go to a regulatory commission, and they have to say, allow us a rate increase because we're not doing very well. So they can actually use the pricing mechanism to make sure they get a 3% growth in net income. So if you have a very regulated, very predictable income stream, you can use historical growth. But there are fewer and fewer of those companies left anymore. I mean, more and more companies have become competitive. Things are changing unto them. And think of what a coronavirus can do to a historical growth rate overnight, right? Overnight, everything you thought you know about the company might have to get thrown out. Let's talk about analyst forecasts. You know how equity, the question, go ahead.
Yeah. What happens if there's a mature company that's been growing well and then like 1 year the growth collapses? Do you suspect?
Why did it collapse? Like Boeing last year? Well, why did it collapse last year? I mean, you can work your way to an answer. It collapsed because of the Boeing 737 MAX. What's the big question you have to ask looking forward? Yeah, and how would you answer the question? Remember, there are only two people you can buy big aircraft from. It's not like you have 15 different aircraft makers. One is Boeing, the other is Airbus. You can go back and forth between the two. And let's face it, Airbus, but for the grace of God, could be Boeing. Right? It's not like Boeing did something incredibly stupid and that's why the I mean, they both have, I mean, if you think about it, flying in a plane is kind of mind-bogglingly scary if you break it down. You're up in this steel tube 30,000 feet high. They tell us, trust us. Nothing is leaking. You say, okay. Right? I'm supposed to fly to Paris tonight, and I'm going to go to sleep and say, please God, let nothing be leaking, because if it is, there's nothing. When they come on and they give you these seatbelt instructions, my reaction is, yes, from 30,000 feet as I'm going down, this is going to save me? I don't think so. No. So it makes me feel better, but the reality is you're in a tube and you're kind of unprotected. And they did have some messy stuff going on with the regulators. I think the question with Boeing is not can they come back, because in a sense you have no place else to go as an aircraft, but how much of a cost they will pay because of the 737 MAX. They're going to get cancellations, they're going to have tens of billions of dollars in costs. So the income will be affected. The revenue growth I think will come back because you have got to buy your aircraft from somewhere, but they might have costs that keep them losing money for a period. Well, they're capacity constrained. You know how many aircraft Airbus can make. It's not like Airbus can say, oh, you want 10 more aircraft? Let's go. Their assembly lines can turn out only so many. So there are capacity constraints both of them use. It's not like switching toothpaste, right? Where you say, okay, produce 10 times more. Building an aircraft, if you look at the aircraft assembly, the factory, it's just really expensive, really difficult, and Airbus doesn't want to invest in building huge new capacity and find it can't use it. So it's not that easy to switch in this business because there are only two big players. Yes? Anybody could go bankrupt. My view is that the chance of it going bankrupt is low simply because they have access to capital and they can find ways to keep going. What could cause them to go bankrupt is if it becomes illegal. Bayer could go bankrupt. Heard of Bayer, the German pharmaceutical company? Why? Is it Bayer? Okay, Bayer could go bankrupt. Bayer could go bankrupt not because we're going to stop buying aspirin. Why could they go bankrupt? What did they do 5 years ago? One of the biggest acquisition fiascos of all time. They bought Monsanto. And my reaction was, are you guys crazy? Because when you buy Monsanto, you bought a heap of lawsuits coming out of Roundup. And it's not, you look out and you see these lawsuits from now through eternity. Bayer could go bankrupt. It was this nice, healthy company 5 years ago. It's now, so that is really what Boeing has to worry about, is there are lawsuits coming out of any of these air crashes, and they become these huge potential lawsuits that could tip them over the edge. No. Yes? You know what? Airlines should be used to losing money by now. They've been doing it for 50 years. To me, when the airline makes money, I say, oh, congratulations, you figured out something new. And you know what? They keep flying. I just don't understand. To be quite honest, this is a business I have absolutely no idea why it keeps going the way it is. It is just it's a horrifically badly run business. And each year they wake up and say, one of these days we'll figure it out. It was deregulation. You know when airlines were deregulated? 1977 by Jimmy Carter, 53 years ago. They're still trying to figure it out. So airlines, you know what, airlines never go away because we fly more than we ever did. If you notice that somebody else comes in and that person needs more aircraft, so guess what, Boeing has an infinite supply of suckers lined up. One goes bankrupt, another will step in and buy more. That doesn't bother me. I think the lawsuits are the one thing that I would worry about, but right now I think that's not a big issue with Boeing. The big issue with Boeing is how quickly can they get their aircraft back, because a big chunk of their sales are being held back because they've got to go and make sure the 737 MAX is ready to fly. Let's talk about analyst forecast of growth. You know how equity research is structured, right? There's sell-side equity research and buy-side equity research. I think I'm going to mention the first session. Buy-side equity research analysts work at Fidelity and T. Rowe Price and mutual funds. Sell-side equity research analysts work for investment banks and put out recommendations. And those are the sell-side analysts are the ones you see on CNBC and talked about in Wall Street Journal. And if you think about how the analyst's job is structured for a sell-side equity research analyst, he's given 15 or she's given 15 companies and told to just follow those companies. So they spend all day, all night. This is kind of depressing if you think about it, for the rest of their lives following these same 15 companies. So you pick one of these companies to value. What's your reaction? They must know more than I do. They spend all their day with these. And they make forecasts of earnings for these companies. So saying if they know so much, they must have additional information. So they forecast growth rates. Their growth rates must include information that I don't have. So let's talk about analyst forecasts of growth and see if in fact they have an advantage over the rest of us. Okay? I'll give you the good news first. On average, analyst forecasts of growth are better than just using time series forecasts. In a time series model, you just take historical earnings and you project it out. That's the good news. The bad news is it's not much. The millions of dollars, the tens of millions of dollars we have in equity research, the way to think about it is if I just use a time series model, my forecast error, you want this error to be as close to zero as possible to get, so nobody gets perfect forecasts. With just time series data, with the computer projecting it, I get a 34% error. All the sell-side analysts' research put together gives them a saving of about 2 to 3%. And that's with 1 quarter ahead forecasts. When I go to 1 year ahead or 5 year ahead forecast, even that small advantage they bring seems to dissipate. Which raises a mysterious question. How, if they have access to all of this information, aren't their forecasts much better than just using a time series model? So I'm going to list out a couple of findings on analysts, and you can form your own judgment on it. When you look at equity research analysts, it's a very strange business because the way you rise to the top is you get on, it's like a football team. There's an All-America analyst, the Institutional Investor, which is a magazine used to pick every year. They still do it. All-America analysts are the best, so they go, Steele, these are the 2 All-America analysts. And if you're an equity research analyst, this is your pinnacle. When you become an All-America analyst, it now becomes part of your name. You're no longer John Lewis, you're John Lewis, All-America analyst. That's why you go to Thanksgiving, who are you? John Lewis, All-America analyst, So basically All-America. And part of it also is it gives a boost to your income. So maybe all analysts, but All-America analysts must be really good at forecasting earnings, right? Otherwise, how would they be? So there was a study that looked at All-America analysts to see if they were much better than the average analysts. And they actually found something very strange. They found in the year before All-America analysts became All-America analysts, they were actually a little worse than the average analyst at forecasting earnings. But the year after they became All-America analysts, they become a little better. So this must be the boost to self-esteem made them. What do you think happens between the year before and the year after that causes these analysts to go from being a little worse than average to a little better than average? Yeah, so if you're John Lewis and you call the company, you say, John Lewis, All-America analyst, the CEO comes on and talks to you because All-America analyst gets it. Your access to information improves. That access to information translates into slightly better forecast. Not huge. No. So when you think about analysts collectively, the kind of forecasts you get from them are actually not as good as you think they are. And I think the reason is actually in the way the business is structured. I think personally sell-side equity research is broken. I know how many of you plan to be in the business, but remember, even broken businesses can pay well and you can have a good life. So don't take this personally if that's what you're planning. And here are the reasons I think sell-side equity research is breaking down. The first is you get tunnel vision. Remember I said you're a sell-side equity research analyst and you track telecom companies. What are you asked to do? Take 12 telecom companies, forget the rest of the world even exists, and this becomes your entire existence. So all you talk about is those 12 telecom companies relative to each other. You've lost all perspective. You don't even know where these companies are priced. That's a tunnel vision. Second, there's a lot of lemmingitis, which is when one analyst, and you'll see this, when Tesla went from 180 to 800, magically every analyst seemed to raise their target price to 1200, and once one did it, everyone else kind of followed. That's a lemmingitis. Everybody wants to. The third is you start to develop a version of what I call the Stockholm Syndrome. What is Stockholm Syndrome? In the 1970s, they discovered that people who were kidnapped after a while started identifying with the kidnappers rather than the people trying to rescue them. Must have been in Stockholm, and I guess that's why they call it the Stockholm Syndrome. Right? You're saying, what's the Stockholm Syndrome got to do with equity research analysts? In theory, what's the job of a sell-side analyst? To ask tough questions of management, keep them on their toes, collect information so you can assess fairly what the company is worth, right? After a while, sell-side equity research analysts seem to forget that their job is to ask tough questions of management. They think their job is to defend the company. You've crossed the line. There's a lot of factor phobia. Nobody wants to talk about the numbers. Everybody wants to talk stories. A lot of sell-side equity research. You're reading and say, where's the number here? Right? Story after story. And finally, it's not as bad as it used to be, but there was a time when sell-side equity research sell-side equity research doesn't charge for its services. So if you're a Goldman Sachs client, you get the equity research for free. So sell-side equity research has no revenues for an investment bank. So why do they do it?
But they used to.
They never have. Sell-side equity research has always been free. But in return, what do they hope you would do? You're a client. You like my equity research analyst. They're hoping you'll direct your trades through me. And that if I need an investment bank, that you will. So in a sense, it's the rest of your revenues. And that's a very dangerous business model. Because I put the sell-side equity research analyst in a very bad place. Do you see why? I don't know whether you remember, but I said there were 9 times as many buy recommendations as sell recommendations coming out of sell-side equity research. Once you create this entanglement where your company could be a potential client, it becomes much more difficult for you to keep distance. So when I look at sell-side equity research as it's structured now, what I see is a shrinking business, a business where people don't read the reports anymore because they've given up. They said, these guys have no idea what they're talking about, or they're so biased that I can't take their recommendations on face value. And that's something I want you to factor in when you find an equity research report on your company. Many of you will, where you see an equity research analyst and he's saying buy your company and your valuation says you should sell, you're going to feel very uncomfortable because that person presumably knows more than you do. But keep these 3 things in mind. First, there's far less private information in that sell-side equity research report than you think. In fact, in the US, by law, there's actually no private information. The SEC put all these restrictions on what companies can reveal to sell-side equity research analysts. It might be different in other parts of the world where you can have conduits where information gets out. Second, the biggest source of private information to sell-side equity research analysts, if they have it, is the company itself. The problem there is it's a very biased source. So the fact that you have a source of information might not give you an advantage. And third, there is value to knowing what analysts think about your company. So when I look at a company and I certainly say, I want to see because it might not tell me what the value of the company is, but it gives me a sense of mood and momentum on the company and what the prices might do. So don't ignore what analysts are saying about the company, but don't let it drive your valuation. So historical growth, not that useful. Analyst growth, not that useful. We're kind of in a bad place, right? Saying, what do I do instead? Let's talk about fundamentals. I'm going to set up a very simple company so you can see where growth actually comes from. So this is what this company is. It has $1 billion invested in existing projects on which it's making 12% return. So $1 billion times 12%, their current earnings are $120 million. This company goes out and invests in new projects of $100 million on which it continues to make 12%. So next year when I look at this company's net income, it's going to be $132 million. You're saying, why did the income go up $12 million? It's very simple. It's because they invest in new projects and the new projects made a 12% return. So your growth in this company came from the fact that you invested more and that you invested well. That combination is what's driving growth. So one of the things we're going to do is we're going to try to ground growth in how much are you reinvesting and how well are you reinvesting. But there is another way you could grow which doesn't require a whole lot of investment, right? And here's what it is. Let's assume, so if I wrote it out as a rate, basically this company's growth rate will be how much they reinvested. 100 million as a percentage of 120 is 83.33%. 120 was their net income. They invested 100 million, so invested about 83%. And the 12% return gives me a growth rate of 10%. How much do you reinvest? How well you reinvest gives me my growth rate. But there is a way in which you can get growth for free. Let me go back to the original example. Remember I did 12% growth rate? If my 12% return equity, if I could improve that return on equity from 12 to 13%, by doing what? Cutting costs, being more efficient. I don't have to invest anymore. My income is going to go up because I became more efficient. There's efficiency growth and there's investment growth. In the short term, efficiency growth is much cheaper because you don't have to reinvest. You get that boom. The limits, though, are you can get only so efficient. So if you're going to tell me you're going to grow 7% a year for the next 5 years by becoming more efficient, I'm willing to listen. It's possible. But if you say you're going to grow 7% a year for the rest of eternity by becoming more efficient, the story doesn't hold up, right? So efficiency growth can be used to explain growth in the near term, but not forever. To grow in the really long term, you have to reinvest money and you have to reinvest well. So what I'm going to do is tie growth to answering those two questions. How much are you reinvesting? How well are you reinvesting? Okay? And the way I measure how much you're reinvesting and how well you're reinvesting will depend on what kind of cash flow I'm discounting. So let's assume that I'm doing a dividend discount model and focusing on earnings per share. How much I'm reinvesting, I'm going to measure with what's called a retention ratio. You heard of payout ratios? Payout ratio measures how much of your net income you pay out in dividends. So when your payout ratio is 30%, you're paying out 30% of your net income in dividends. But if you're paying out 30%, the remaining 70% is going back in the company. That's called a retention ratio. So if I'm looking at earnings per share and you ask me how much are you reinvesting, I'm going to look at that retention ratio. And if you ask me how well am I reinvesting, I'm going to look at the return you make on your equity. Right? Because everything is equity focused. So with earnings per share growth, retention ratio becomes how much you reinvest. Return on equity becomes how well you reinvest. If I'm looking at net income from cash flow, not per share numbers, then I'm going to have to do my dirty work myself. I can't just look at the retention ratio. I have to look at what you actually invest in CapEx and working capital. And if you do borrow money, I will allow you that benefit, saying you invested less, but I'm going to divide that with the net income. That's called the equity reinvestment rate. Again, the higher that number, the faster I can grow. And I'm going to compute the return on equity you make on your actual investment. So it's a little more work because you're not taking the face level numbers as a given. And finally, if I'm looking at operating income, I'm going to measure how much you reinvest by looking at net capex and change in working capital. And I'm going to scale it not to net income but to after-tax operating income. If you're tracking all these numbers as we go through, whether it was discount rates or cash flows, the key is once you make a choice up front in how you approach valuation, every number you estimate is going to be driven by that choice. So early on you said, I'm going to value equity. Then you compute a cost of equity. You start with net income. You compute cash flows to equity. When you talk about growth rates, there's always growth in equity income. And every parameter you compute will be an equity number. So reinvestment rate becomes what you put back. And return on your overall capital becomes a measure of how well you're reinvesting. So those all look like different equations. In fact, if you take your lecture notes and start writing out every equation you run into, you're going to have like 5 pages of equations and it's going to be completely useless. Too many equations. But basically what you have to recognize is I'm taking the same equation, just restating it in different ways depending on what kind of income I'm looking at and how I'm measuring that income. So let's talk about estimating growth using this approach. So here what I've done is I've set up a problem where I'm going to look at how much you're reinvesting, in this case by looking at your retention ratio, and how well you're reinvesting by looking at your return equity. For a company in the long term, its growth rate is going to be driven by the product of those two numbers. So let me throw some numbers at you. You have an 80% retention ratio and you have a 20% return on equity, your growth rate is going to be 16% a year. You have a 10% return equity and an 80% retention ratio, the most you can grow is 8% a year. Your return on equity becomes the ceiling on your growth rate. You cannot grow faster than your return equity once you hit steady state. You know where I use this approach the most is when I look at banks. Because with banks, there's no operating income, it's everything equity focused. So let's take an example. This was Wells Fargo in 2008, just before the crisis. I remember valuing Wells Fargo in August of 2008, a month before the crisis. And here's what the numbers look like. Their return equity looked sky high, 17.56%. They were doing really well. They were reinvesting about 45% of their net income back. And in 2008, before the crisis, you asked me how quickly can Wells Fargo grow. I'm going to take 45% times the return equity and come up with a growth rate of about 8%. So my valuation will be built on that growth rate. A few months later, of course, the crisis hit. And one of the things that happened in the aftermath of the crisis was regulatory authorities got really nervous about how much banks had as capital. So they imposed a requirement that banks raise their regulatory capital. So let's assume that the regulatory guys have shown up at Wells Fargo and said, look guys, you can continue to do what you did before, but you need 30% more book equity to keep going. I haven't got any new information on Wells Fargo, but with that new edict in place, here's what happens. If I increase my net income by 30%, okay? I'm sorry, my book equity by 30%, my return equity, instead of being 17.56%, is going to drop to 13 or 14%. Same net income, but because I need more capital, the return equity drops. And with that new return equity, my growth rate, instead of being 8%, drops to 5.5%. So if you're looking at banks, this has become the bane, the problem for banks, is in the last decade, regulatory capital requirements have gone up. They might be as profitable as they used to be in terms of generating net income, but their return equity has come down. And if your return equity comes down, your growth rate comes down. If your growth rate comes down, the value of your equity comes down. It's created this vicious cycle where they think they're doing really well in terms of return equity, but it just is not playing out as a higher growth and a higher value. So it allows you to connect things that are happening to your book equity, to your return equity, and your growth rate. One final point about return equity. If your growth is a function of your return equity, you'd like to have a high return equity, right? One of the ways you can get a high return equity is you can do what Apple and Google do, take really good projects, but that's so much work. You know the other way you can get high returns on equity? You can take average projects and lever up like crazy. That's what real estate does. Real estate, the typical return on a real estate building might be only 7 or 8%, but if you borrow enough money, you can make that 7% into 17 or 27 or 37%. In fact, you can break the return equity down into two components. You can compute a return on capital, if they had no debt, what their return equity would have been, plus the leverage effect. The leverage effect is how much you borrowed, captured the debt to equity ratio, and the difference between what you make on your building minus your cost of debt. So basically, you're taking advantage of the fact that you're borrowing money at 3 and investing at 7. The more you borrow, the higher the return equity. The only catch is, as you do this, you're getting riskier. Your cost of equity is also going up, but at least you can show much higher returns on equity. So I'm going to show you an example, and this is a very old one. In fact, the name of this company, it used to be Brahma, it's now Ambev, it's a Brazilian beverage company, had a sky-high return equity. They had 31% return equity, and this was in 1998. And I was curious as to why the return equity was so high. So I broke it down. Their return on capital is about 20%, which is pretty good to begin with. They'd borrowed 77 cents for every dollar. That's the debt to equity ratio. And because their cost of debt was only 5.61%, as they borrowed money, their return equity kept going through the roof. And this is a tactic companies use. It's not a bad tactic. It's not a good tactic. It's reality. But does debt always increase your return equity? Take a look at what's inside the brackets. What's got to be true fundamentally for debt to even increase your return on equity? Forget about value of equity because that's an even more messy question. What has to be true? You have to earn a higher return on capital than what you pay out on your debt, right? Very fundamental. So I grew up in this part of India called Chennai, and I haven't been home. I left 41 years ago. But every time I go back home, because I still have, my parents still live there, people seem to find out I'm coming, and all of a sudden consulting assignments, pro bono consulting assignments show up. Basically say, and these are from people I've known since I was a kid, so you can't even say no. So this was about 25 years ago, I was going back to India, and I get a call from my uncle. You really can't say no, and he was the chairman of a board of directors of a company called Titan Watches. It's actually a pretty well-known Indian company. And he said, we've been following the rule book of borrowing money to increase return equity, but we keep borrowing money and our return equity keeps going down. Can you come in and talk to us about what's going on? So I said, I think I have a clue, but let me work through the numbers. So their return on capital as a company was 9.5%. And this is India in the late 90s, early part of the 2000s. 9.4. Not bad, right? But it was in Indian rupees. They were clearly borrowing money. For every dollar of equity, they had $1.91. So he clearly wasn't lying when he said we're borrowing money and continuing to borrow money. But you see the problem that they were facing? The cost of debt after taxes they were paying was about 10.1%. They were making 9.5%. Every time you borrow money, what's going to happen here? Your return on equity just gets lower and lower and lower. It's a kind of minimalist requirement. If you're going to borrow money, at least make sure that what you make on the project you borrow to fund with that money is great. It's not even going to increase value, but at least your return equity mathematically should go up. So when you think about a company with high return equity, just check to see, is that high return equity coming from the fact that it's taking great projects, which is wonderful, or is it coming from the fact that they found a way to use debt to leverage up that return equity? So that's a very simple return equity times retention ratio. Now let's move to expected growth in net income. The problem with per share numbers, and I almost never do my valuation with per share numbers. You'll see this as we go through the class. None of my valuations are done on a per share basis. They're all done with aggregate income, and at the last stage, I divide by the number of shares. And the reason is very simple. If you have options and other claims in your equity, using a per share number can get you into serious trouble. So often I focus on net income or operating income, and I try to grow it. And if you're focused on net income and growth in net income, not per share numbers, you've got to be a little more careful about how you compute how much you're reinvesting and how well you're reinvesting. So when you compute net income, for instance, I'm going to take cash out of the picture because cash is such an easy asset to value. Why let it mess up my calculation? I'm going to look at the net income from non-cash assets. When I look at equity reinvestment, I'm going to look at not just what you retain, but how much of it you actually put in projects. Because remember, you can retain income and just leave it in cash, which doesn't help me. So I'm looking at net capex and change in working capital. And because it's equity based, I'm going to allow for the fact that some of this might come from debt. So that's my reinvestment. And for the return equity, I want to take the net income you got from non-cash assets and look at how much this company has invested in its book equity, which is not cash. Then my growth rate is just going to be a product of those two numbers. So let me try this on Coca-Cola. In 2010, Coca-Cola reported net income of $11.8 billion. Insanely profitable company. Book value of equity was $25.3 billion, and its cash balance was $7 billion. It earned an income of $105 million just on the cash balance by investing in commercial paper and T-bills. Its capital expenditures were $2.2 billion, depreciation was $1.4 billion. All of these numbers come right out of the statement of cash flows. I didn't have to dig too deep to get it. And the working capital went up by $335 million during the year. I want to compute the equity reinvestment rate and non-cash return on equity for Coca-Cola. So here's what I started with. I computed the equity reinvestment by taking capex minus depreciation plus the working capital change, because that's an investment too, minus the increase in debt of $150 million. Overall, Coca-Cola invested less than $1 billion, $957 million. As a percentage of their non-cash net income, they're reinvesting only 8% of their money back into the business. Now normally when you reinvest that little, your growth rate is going to be tiny. But because Coca-Cola's return on equity is insanely high. Why? Because what does Coca-Cola make? It doesn't even own its bottling plants. Unlike Pepsi that has, Coca-Cola spun its bottling plants off, all Coca-Cola sells is the syrup, which costs it nothing to make. Its biggest expense is actually advertising, so its margins are sky high. The return equity of 64%, you take the product of those two numbers, 8 times 64. Your expected growth rate as Coca-Cola is actually a pretty healthy number, 5.22%. But it's not being driven by huge amounts being reinvested back in the company. It's being driven by the return equity they make in their existing investments. Any questions on? So when you go from earnings per share to net income, you've got to be more careful about how you compute equity reinvestment rates and returns on equity. Let's talk about operating income. When you're trying to compute growth in operating income, you have to kind of step back because now you're looking at the entire firm. Because you're looking at the entire firm, your reinvestment rate is based upon what your after-tax operating income is, not net income. And your return is computed based on what you got invested in all capital, not just the equity capital. So reinvestment rate and return invested capital become the analogs to what you used in equity. And the combination of those two is going to give you your expected growth rate. This is a measure of what I call how efficiently you deliver growth. You can have two companies with the same growth rate, but one can be more valuable than the other based upon what they're reinvesting to get the growth rate. So ready? I'm going to give you a couple examples and you can decide where the value is going to be highest. So let me again return to two companies that I valued in 1999, Cisco and Motorola. Cisco's reinvestment rate was 107%. Let me pause right there. How can you have a reinvestment rate that's higher than 100%? What do you have to do as a company? You got to raise capital, either borrow money or raise equity. Cisco was growing. So that's one of the advantages of moving away from payout ratios and retention ratios. Because there, what's the lowest payout ratio you can have? It's 0. What's the highest? 100. Once you look at overall income, you can reinvest more than your operating income if you're willing to tap external capital. So they were growing at 107%. But what was impressive about Cisco is while they were reinvesting these immense amounts of money, their return on capital was 34%. So in 1999, when I computed a growth rate for Cisco, 107% times 34% gives me a growth rate of 36%. Motorola is a very different company. Its reinvestment rate is not bad, 53%. Its return on capital is not bad, 12%. But what's not bad times not bad? Not bad. The growth rate is not bad as well, 6%. Would Motorola like to grow like Cisco? Of course. But pigs can't fly. I'm not suggesting Motorola is a pig, or maybe I am. But I'm saying companies sometimes give you these plans. We're going to grow at 30% a year. But if you're a company with a 10% return on capital and you're reinvesting 50% of your income, you cannot grow at 30%. You have to stop being unrealistic because your fundamentals kind of fight against it. What this allows you to do is bring companies back to earth, because if you let them give you a growth rate, and management say, put a 20% growth rate, you got to turn this back on them and say, I'm willing to do that, but tell me what's going to change. Because your return on capital is only 10%, are you going to reinvest 200%? Which means you got to go out and borrow incredible amounts of money, raise equity. No, I don't want to do that. Is your return on capital going to jump to 35 or 40%? In which case, tell me what's changing in the business. Ultimately, you got to make people defend why you should be using the growth rate. Because otherwise, you're going to be completely vulnerable. You're going to be sitting there saying, okay, you know more about the company, I'll use 20%. You've lost control of the story and you've lost control of the valuation. So if you look at all the approaches I've described so far, they're built on an accounting return on equity or return invested capital. Do any of you have trouble sleeping at night? You might now, the quiz is coming on Monday, but do you regularly do? If you do, I think I have a solution for you. It's a paper I wrote about 20 years ago that was so incredibly boring that I fell asleep multiple times while I was writing the paper about estimating accounting returns for valuation, return equity. It runs 65 pages about all the things you have to fix in a company to get a better measure of what its return equity, because everything we do is what's your return equity, what's your return invested capital, and you think it'll be easy. Yes, let's see why this number is so troublesome. In the numerator, you have after-tax operating income. Exactly the same number you start your free cash flow of the firm with. In the denominator, your book value of equity plus book value of debt minus cash. That's what the accounting definition. It's the only place in finance we ever use book values. When we did debt to equity ratios for levered betas, always market values. When we do debt ratios for cost of capital, always market values. But when we do accounting returns, we always do book values, and there's a reason for that. If what you're trying to compute here is what kind of returns am I making on my existing projects. If you use market value, you're getting the market value of the entire company, which might include future growth. So we use book values, and that opens us up to all kinds of issues. Like what? Anything accountants do to screw up book value is also going to screw up your return on equity and return on capital. Like what? You heard of companies taking restructuring charges? You know, when companies take restructuring charges, you make a really big mistake. At some point in time, your accountants wake up and say, you made a really big mistake, we're going to write off 10 billion. Sounds like the logical thing to do, right? Mistakes should be written off. The minute you write off 10 billion, what happens to your book equity? It drops by 10 billion. Let's say 2 years later, I'm computing the return equity for your company. I divide net income by book equity. I'm going to get this really high number. I'm going to conclude you took great projects, right? When in fact, you wiped your mistakes out. Restructuring charge is a problem. You have goodwill, you impair the goodwill, it affects your book value of equity. You buy back stock, it affects your book value of equity. So what I did in this paper was actually take a series of things that I had to kind of correct for to get to a return equity and return invested capital that actually made sense. Along the way, I capitalized leases in R&D. In fact, the reason I capitalized leases in R&D is precisely because I want to get a better sense of what are you making as returns on your projects. This is the end game that drove all of those computations. So if you read this paper, I go through all of it. By itself, as I said, it's incredibly boring. It's more like a manual, because when you sit down with the company, there might be a specific item you run into. So what do I do? That paper will probably have a little section on what to do about restructuring charges, or if your company has a big impairment of goodwill, or what if your company has negative book value of equity. You know that 1 in 9 US companies have negative book value of equity. How do you end up with a negative book value of equity? You either had losses year after year, or there's actually a shortcut you can take. You could be a healthy company with a negative book value of equity. Let's say you're a company that does a $15 billion buyback. You buy back stock at market value terms, right? Let's say your book value is only 1/4 of your market value. You could buy back 20% of your stock, and the next thing you know, your book value of equity turns negative because you bought back stock, which creates all kinds of issues. How do you compute the return equity for a company with negative book equity? The answer is you don't. You just give up. You can't compute return equity. So when you look at this, basically don't know what you're looking for is there something in my company I need to clean up for to get a better measure of what it earns on its projects, either as return equity or return capital. Let's pause, let's stop there. The quiz will not cover anything with growth, which is good because most of you look glazed over, and if I tested you on return on capital, you'd probably blow up the quiz. So that's good. It'll be through cash flows. Okay? And when you do get a chance, catch up on growth. You won't get a chance on Monday. So I will see you on Monday.
Original return on capital, are we assuming that a new investment we make has a reasonable assumption?
Don't ask questions if you don't have something to ask. That's what it started with. what estimates growth, then what you need to say is the earnings growth. Anything that tells you about it. So think about what you want to accomplish and then go look at it. Don't go looking first and say, maybe I'll find something that you can do. The reason you get it out is you look at the earnings growth with all this stuff and say, what do I need for that? You know what you're looking for. You want to achieve it. So start with focus. Focus companies. So I want to know what return on capital might be. If you can read the earnings calls with any information specific to the earnings, but you need to have focus when you go look at it. Otherwise you're going to get it.
Is your SRI also to get to know like the sentiment of the company's executives?
Very easy. Look at what the price is doing. That's what sentiment shows up.
Like just the way that you're talking about it.
The talking doesn't matter. The action might. If the stock price went from 50 to 90, sentiment goes up. Otherwise the price. So look at the price. The price will tell you everything you need to know about sentiment. Sentiment is not an input to valuation. Maybe when you get to the pricing stage, you're not going to look at it. But right now, you need to value the company. Sentiment is irrelevant if you have to value it. Sentiment is a pricing right. So when you come to multiple profits, you're not going to look at it. But don't look at sentiment now. You got to make that
So also you were talking about like equity analysis. When you have a lot of companies,
They cannot. In the US, by law, you cannot have any.
they always like mention that they have direct.
Legally, it's not allowed. They don't have the US medicine. It's illegal to do it.
They have like more communication.
Very limited. Management, when they talk to analysts, so almost all analyst calls, if you look at earnings calls, all analysts are also public. The reason they've been made public is because companies have to give the public a chance to get the information. The only kinds of information analysts might be able to get very fuzzy information. Our inventory is low, or even that might be breaking the law. So by law in the US, an analyst cannot have information, which is part of a problem for an analyst, because it used to be that they had at least some information that was proprietary.
So the earnings call are the only.
The earnings calls are not only analysts, right? Earnings calls are public. That's why you were able to check on the earnings call. So nothing that analysts hear can be just for analysts. You see what I'm saying? So when they make an earnings call, it used to be only analysts listened in on an earnings call in the old days. Because in those days it wasn't done online. It used to be that the analysts would gather together in a room, the management would come out and tell them about what is an earnings call, was really an earnings report to the analyst. And the analyst would ask questions that the managers were allowed to answer about the company. Why is your earnings down in China? The analysts, so managers could give proprietary information. That's no longer allowed. You can't do that in the US. Maybe in the rest of the world you still can do that. But in the US you can't do that. Okay. Thanks. Oh, yeah.
Actually, two questions. The first, well, both are connected to the quiz. Last week, I missed like a week of instructions, right, because I was sick.
Okay.
And because of that, I have a question to you, whether I may shoot you an email if I will have like any questions. Okay, great. And the second one is about the quiz again.
Yeah.
Thing is, I'm registered with most center, and I have like a time and a half on.
They work it out. So basically what I do is I email the quiz to them.
Okay.
You show up at the Moses Center. I would ask them whether you can start earlier because there's class after the
Yeah, I
quiz.
got
So
it.
ask them whether you can start 15 minutes earlier.
Yeah, that would be fine.
And no, you have to work with them. That I don't.
Yeah, I'm
set
just
it
like
down.
telling you that I don't have any class.
Yeah, so
schedule.
basically it's start 15 minutes ahead of time and they will have the quiz there and you can
Okay.
take it there and then come here when you're done.
Okay, great. Thank you.
Okay.
Excuse me, I was trying to value Spotify, and I was trying to complete the exposure to the country screen, but I saw it on the annual report, they only break down revenues in the US, UK, Luxembourg, and rest of the world, which accounts like for 51%.
Then you have to do whatever you have to do. That's actually the screens to each of those.
Yeah, but like the rest of the world, outside
Just take out the US, the UK, and Luxembourg from your 160 countries and create the weighted average equity risk rate. The rest is allowed. Right? There's a GDP next to each country.
yeah,
You said 0, 0, 0. So basically what you do is you set zeros. So right now it has actually the GDP for the US. That's how we get the weighted average for the whole world.
Yeah.
Take the GDP for the US, UK, and Luxembourg, set them to zero. And then compute a weighted average. Effectively, you're getting an equity risk premium.
Even if Spotify is not in those countries, like Spotify is not in China and Russia.
How do you know? The rest of the world, how do you know? So unless you want to start saying the rest of the world, but not China and Russia. If you want to do